beneath the polished.
Most of us live our financial lives in the light. We deposit our paychecks into local commercial banks. We trust these institutions because they stand under the heavy gaze of government regulators. They are backstopped by central banks, heavily insured by deposit protection schemes, and operate with a certain boring, predictable transparency. But out of sight, beneath this familiar surface, an alternative financial universe handles trillions of dollars every single day. Welcome to the world of shadow banking. Formally designated by the Financial Stability Board as non-bank financial intermediation, this is the hidden plumbing of global finance. It is an ecosystem composed of money market mutual funds, hedge funds, special purpose vehicles, and deeply complex collateralized lending networks. And it operates almost entirely within regulatory blind spots. To understand the scale of this invisible web of wealth, consider this. By 2021, the global shadow banking sector's assets were estimated at nearly $239 trillion. That is nearly half of all financial assets on planet Earth. Yet the physical manifestation of this immense wealth is shockingly unremarkable. Picture the sun-drenched, palm-lined streets of Georgetown in the Cayman Islands. There sits Ugland House, a stark white facade with blue-tinted windows, 5 stories tall. It looks like any mid-tier corporate office. Tourists offload from cruise ships just blocks away, completely oblivious to the financial gravity contained within those walls. But this singular, unassuming building serves as the legal registered address for over 40,000 corporate entities. It is a portal into a system designed to create immense credit, utilize offshore tax havens, mask elite ownership, and hold the terrifying power to trigger cascading global economic failures overnight.
The repeal of Glass-Steagall unleashed a new era of risk.
Ironically, this massive, obscure system began as a populist movement, an attempt to democratize finance for the average citizen. In 1971, inflation was devouring the savings of ordinary Americans. Traditional, heavily regulated bank accounts had strict interest rate caps, known as Regulation Q, which prevented banks from paying depositors a fair, market-driven return. Enter Bruce Bent and Henry Brown. They established the Reserve Fund, the world's very first money market mutual fund. Their innovation allowed the little guy to pool their money and access the high-yield wholesale interest rates previously reserved exclusively for massive corporations. It was a brilliant, democratizing loophole. But what began as a tool for financial liberation slowly mutated over 4 decades into the ultimate mechanism for elite wealth concealment and unchecked risk. The real acceleration occurred in 1999, when the Gramm-Leach-Bliley Act repealed the historic Glass-Steagall Act of 1933. For decades, Glass-Steagall had maintained a strict, impenetrable firewall separating safe, regulated commercial depository banks from the high-risk gambles of investment banks. Its repeal officially blurred the lines, acting as a massive catalyst for Wall Street. Suddenly, banks were highly incentivized to move their riskiest operations off their official balance sheets and into shadow entities, unencumbered by the strict capital reserves required of traditional depository institutions. These new, invisible structures could generate staggering profits. By keeping these operations in the shadows, Wall Street banks could maximize their leverage, transforming a populist savings tool into an unregulated multi-trillion-dollar credit creation machine that operated entirely outside the safety nets of the traditional banking system.
This is the shadow banking system at work.
To truly comprehend how the shadow banking system operates, one must look at its obscure, highly complex internal mechanics. Traditional banks create credit through a simple system of deposits and loans. shadow banks rely on entirely different mechanisms, most notably rehypothecation and orphan structures. Imagine an academic flowchart where a single financial asset, such as a supposedly safe U.S. Treasury bond, is transferred between a hedge fund, a prime broker, and a third-party lender. In the shadow banking world, this asset is not simply held, it is reused. Rehypothecation is the practice where a financial institution uses a client's collateral for its own purposes. Prior to the 2008 crisis, places like the United Kingdom had no legal limit on this practice. A single sovereign bond could be used as collateral over and over again, creating a dizzying daisy chain of phantom debt. Multiple parties were essentially claiming ownership of the exact same asset to secure different layers of credit. It was a house of cards built on an illusion. And to keep these immense risks entirely hidden, Wall Street lawyers invented orphan structures. When a bank wanted to move a multi-billion-dollar special purpose vehicle off its balance sheet, they would place the equity of that entity into a charitable trust. Technically, the multi-billion-dollar financial entity became owned by a generic, often obscure charity, which usually received a tiny nominal fee for its participation. This clever legal fiction severed all legal liability from the Wall Street bank that created the vehicle. It became a financial ghost, legally owned by no one, yet controlling millions of dollars, navigating the global economy completely unseen. The fragility of this phantom economy finally fractured in 2007. During the Federal Reserve's Jackson Hole Economics Symposium in August of that year, PIMCO economist Paul McCulley stepped to the podium. Seeking linguistic clarity to wake up complacent regulators, McCulley officially coined the term shadow banking. He urgently warned that uninsured commercial paper was functioning exactly like bank deposits, but entirely without a safety net. His warning was prophetic. That same month, French bank BNP Paribas suspended withdrawals from 3 of its hedge funds, citing a complete evaporation of liquidity in the shadow market. It was the terrifying dawn of a modern financial crisis, one not playing out in retail bank branches, but in the invisible repo markets. The devastating crescendo arrived on September 15, 2008. Lehman Brothers collapsed, sending shockwaves through Wall Street. The iconic images of shocked employees carrying cardboard boxes out of their New York headquarters symbolized the devastating real-world collapse of the shadow banking nexus. The very next day, the original shadow bank, Bruce Bent's Reserve Primary Fund, did the unthinkable. It broke the buck. A line chart from that day shows the fund's net asset value, steady at $1 for years, violently dropping below the dollar line. It was a catastrophic signal. Panic erupted on trading floors. Amidst the smell of stale coffee and anxious sweat, illuminated by the flickering blue glow of Bloomberg terminals displaying plummeting red numbers, the massive, invisible web of shadow credit simply ceased to function. The system had frozen, threatening to plunge the entire global economy into a new depression. In the desperate aftermath of 2008, central banks stepped in. The Federal Reserve effectively bailed out the shadow banking sector, providing emergency liquidity to money market funds and broker-dealers. This action ignited a massive ideological debate. Pragmatists argued the Fed had no choice but to save the system to prevent a total global collapse. But purists warned of a terrifying moral hazard. The government had essentially extended a guarantee to unregulated entities, privatizing their astronomical gains while socializing their catastrophic losses. The system survived, but it did not reform. Instead, it retreated further into the shadows, relying heavily on an intricate global network of offshore havens. The true extent of this secrecy was exposed in April 2016 with the release of the Panama Papers. The International Consortium of Investigative Journalists leaked 11.5 million documents, tearing the veil off the global elite's hidden wealth. Imagine a sprawling, high-tech data visualization network graph rendered in bright neon blues and pinks against a stark black background. These interconnected nodes represented shell companies, offshore accounts, and the hidden fortunes of the world's most powerful people. The system relies on nominee directors, faceless individuals in jurisdictions like the British Virgin Islands or Panama, who legally direct thousands of shell companies simultaneously. Their sole motivation is simple fee collection, but they provide a vital, impenetrable psychological and legal shield of anonymity. They are the human firewall protecting the true beneficial owners of the world's wealth, ensuring that trillions remain safely outside the reach of domestic taxation and regulatory oversight.
Despite the devastating lessons of the past, the shadow banking ecosystem continues to grow, evolving new, highly leveraged threats. The sheer volume of unregulated capital sloshing through the global system remains a ticking time bomb, driven by a deep-seated culture of regulatory arbitrage. Consider the catastrophic collapse of Archegos Capital Management in March 2021. Founded by Bill Huang, a deeply religious but aggressively risk-seeking financier, Archegos operated as a family office. This designation allowed it to function virtually unregulated, acting as a massive shadow hedge fund out of sight of the SEC. Huang utilized complex derivatives known as total return swaps to amass staggering leverage, prioritizing invisible market dominance over sustainable, transparent growth. When the bets turned against him, the resulting implosion inflicted over $10 billion in losses on major global prime brokerages in a matter of days. A split screen of the modern glass facade of Archegos Capital next to the massively plummeting stock charts of Viacom CBS and Discovery serves as a grim reminder of this modern menace. Shadow banking proponents still argue that this system provides vital, flexible credit that traditional sluggish banks simply cannot offer, acting as a necessary lubricant for global economic growth. But critics see a systemic parasite, a system perfectly engineered to sidestep the rules that govern the rest of us. So long as trillions of dollars are permitted to flow through the dark corridors of offshore havens, orphan structures, and invisible lending networks, the global economy will remain at the mercy of the shadows. The real wealth of the world is hiding, and it is holding all of us hostage.